I'd like to thank everybody for joining me today. Today, I want to talk about using charitable lead trusts. This is wrapping up. We've talked a lot about charitable planning, but charitable lead trusts really have a unique feature to them, and it really comes from being able to save taxes now, and also if you're working with a charity to be able to see the good that you're doing with your charitable giving. So when you look at charitable planning, most people think charitable planning. I only use charitable planning if I'm charitably inclined. I talk to a lot of clients and they never think about charitable planning other than if they're actively involved with a charity, a community, a church, whatever they're involved with. But if you really think about it, it also expands out to individuals that are looking to reduce their income taxes. And on the flip side, those that are looking to reduce estate taxes. So if you look at this, honestly, I think this, really encompasses all of us, whether we're charitably inclined or not. Most of us want to reduce our income and estate tax problems. So if you start looking at this and understand the tax code encourages charitable giving, it's, and using the charitable lead trust, it's just a great tax planning tool. And it comes into, it's not in the gray area. It's a very black and white planning area for the tax code. The nice thing about charitable lead trusts is this is a great way to reduce your income tax after the sale. After that tax has been triggered, you can use a charitable lead trust basically retroactively to wipe out that tax bill. A lot of our other tax planning tools, charitable remainder trusts, that we've talked about before, all of that has to be done before the sale happens. But here we can create tax deductions after we've created the taxable event. So if you start looking at charitable lead trust, the big part is understanding the mechanics. And when you start looking at the mechanics of a charitable lead trust, it sets up very similar to a charitable remainder trust. So they're almost mirrors of each other. But it all starts with the client. We want to make sure we understand the client, understand their situation, and make sure we understand what we're trying to solve. So the very first step is to form the charitable lead trust. The charitable lead trust is an irrevocable trust. The client can also be the trustee of the trust and oversee everything. Don't have to, but they can. But the trust is designed to make sure it fits our client's needs. Once we have the trust organized, the client's going to name a charity. That charity can be revocable, can be irrevocable. That charity can be a donor advised fund. It can be a private foundation. All of these, all of these charitable organizations are going to be fair game for our client to choose. Depends on how involved they are with the charity. I like using a donor advised fund because now the client can pass that money on to a donor advised fund and then over time distribute that out to a 501c3. There again, it's what our client wants, and it depends on where they're at in their charitable giving legacy planning. Once we have all of this set up, now we can transfer property to the charitable trust. Now understand, this can happen after we've had a tax triggering event. So you've sold an investment property, you've sold stock or bonds. All of those things trigger ordinary income or capital gains. Now we can transfer property to the charitable trust. We can actually, in this case, transfer cash into the trust and generate our taxable deduction that way. Once we have the money into the trust, then that's going to trigger the charitable deduction. So the day we transfer it in is the day we calculate the charitable deduction. And the client has that available to them. Once the money or property is inside the trust now will reinvest the proceeds under the trust name, under the trust tax ID number, and we'll want to work closely with the client, because a charitable lead trust, any taxable gains or losses that occur inside the charitable trust are going to be taxed back to our client if it's a non-grantor charitable lead trust. So think about this. Just remember this, I would say, Our client is going to get a K-1 from the trust every year telling them what they have to report for gains or losses involved in that trust. So a lot of times we'll want long-term investments, and then just making sure we're creating enough income to be able to take care of our charitable giving that we've got to do each year. And that brings us to the next step of the charitable lead trust. We are going to create an annuity stream to the charity every year for a set number of years. So as part of setting up the charitable trust, we'll determine, is this a 5-year, 10-year, 15-year trust, whatever it is. During that trust period, whatever percentage rate we set, that's what we're going to pay out to the charity every year. Now, at the end of that trust term, whatever's left in the trust reverts back to our client. So over that time period, whether it's 10, 15-year period, whatever it is, think about how this works. We're going to have the money transferred into the trust. The trust is going to have growth on that money. That growth is taxed back to, if it's triggering taxable income or gains, that will be taxed back to our client each year. That balance will be reduced by the annuity payment we pay out to the charity. Now, whatever's left at the end of the trust period reverts back to our client. So that is, in this case, the annuity payment goes to the charity, the remainder comes back to our client. So this can create a great opportunity to create, tax deduction now, but bring that principal back to our client, for their retirement years. So it can be a great planning tool there. Let's look at some numbers. So if you think about this, let's have a gift amount of $1 million. Keep it as cash just to keep it simple. So our client puts in $1 million cash transferred into the charitable lead trust today. They're going to decide when they set up the trust, do they want this, for how many years? And so I've got a comparison here and just saying, if we do it for 10 years or 15 years, how would that look? If we've got to pick an annuity payment amount. Now that percentage amount's not going to change. Once our clients makes that decision, that's set in stone. So that could be 5, 6, 8, 10%, whatever the client wants that to be. Once we have that, now we know what our annuity payment is going to be each year as that's paid out to the client or to the charity. And you can see now it's going to generate a large charitable deduction. So if we have a 10-year, 6% annuity, $1 million of principal goes in, we've got $60,000 a year being paid out to charity, and our client will get a $467,838 tax deduction that they can use now and for 5 rollover years until that charitable deduction is used up. If we add that extra 5 years on there, so we change it from a 10-year charitable lead trust to a 15-year lead trust, that increases our charitable deduction to $631,284. Now, let's think about what our client's going to look at here. They put $1 million in. They're going to have that money invested. If the investment is returning 6% or higher, at 6%, they put $1 million in, they pay out the $600,000 or $600,000 over that 10-year period to the charity. If we've been running even, our client's going to get ballpark $1 million back to use for their retirement years or whatever they need it for. If we're investing and doing better than 6%, they're going to put $1 million in, they'll pay $600,000 out to charity over that 10-year period, take a $467,000 deduction, and when the trust terminates, they'll bring back into their estate more than the $1 million that they put into the trust. So this can be a great tool for our clients to offset taxes now during the working years, offset taxes on the sale or of a large asset that's generating a lot of taxable gain, but also to be able to have that money to use for their retirement years, for their other planning needs. So great tool, great planning tool, great tax tool. So if you have questions on this, feel free to reach out and we'll talk again next time. Thank you.